And good morning. My name is Laura Sager. I am the membership director here at the Conejo-Simi Moore Park Association of Realtors. Welcome to our webinar on what triggers a property tax assessment. We have two panelists with us here today. Keith Taylor is the Ventura County Assessor, and Roxanne Danielson is the Senior Title Officer at Chicago Title in Oxnard. Welcome, both of you. We are going to start off the presentation with Keith Taylor, and he has some slides to share with you. This is being recorded for anybody that has to drop off a little early or can't attend the whole webinar, and all the slides will from both presenters will be available to everybody who attends. So Keith, I will let you take it from here.
All right, good morning. Good morning, everyone. My name is Keith Taylor. I'm the assessor in Ventura County, and I was asked to talk today about what triggers reassessment in California. And the basic reality of that is Proposition 13, which was passed in June of 1978. And that really dictates when the assessor can reassess any property in California. The mastermind behind Prop 13 was Howard Jarvis. He co-authored it with Paul Gann. He wanted to they were a little disturbed with the way property values were increasing so rapidly in California in the mid-70s. And they wanted to somehow control that increase in property taxes and also the amount of taxes that the state and local jurisdiction collected. Howard Jarvis was a businessman and apartment owner, and he really put his platform out to older property owners that might be taxed out of their homes because of high property taxes. And so he co-authored this initiative called Prop 13 to see if the voters would agree that it would be more of a stabilized increase on property taxes for the owners of California. So the couple things that Prop 13 did is it said that the assessor would reestablish base year values for all property in 1975. So if he had bought a house in 1967, the assessor would still establish what was called a base year value for lien date 1975, and that value could only go up a maximum of 2% a year. If someone had bought a house in 1977, their market value was reduced to the 1975 base year value, and again, that could only go up 2% a year. What this did also was in Prop 13 said that the tax rate, which at the time was about 2.3%, would be stable and assessed value every year.
Keith is freezing up on his camera here, so let's see what we can do to fix that. Hold on just a moment, everybody. All right, looks like Keith is trying to rejoin the meeting, so we're hoping that his internet is a little stronger when he gets back. So thanks for your patience, everyone.
Can everyone hear me?
Yes, we can hear you. So we can try queuing the camera off at this point. I think that might help. Are you able to share your screen? All right, so I think at this point we're going to switch over and have Roxanne take over with her presentation. Keith, we're going to have Roxanne take over at this point.
Hi, everyone.
Morning.
my
Thank
name is
you.
Roxanne.
Okay,
Oh, there you go, Keith. You want to finish? Are you there?
whatever's preference of the group.
Okay.
Yeah,
Good.
so we can hear you. So if you are you able to share your screen?
You see it now?
So you're sharing your screen, but it's black.
Yes. Okay, so.
Oh, there we go. Okay,
so
that looks
Once
great.
the
Thank
assessor
you.
established that. Got it. So once the assessors established that base year value in 1975, that was one of the provisions of Prop 13, and they didn't have to do that again. So the other two provisions that allow the assessor to reassess property is a change in ownership or any new construction. Change in ownership. What happens with that is the assessor usually receives a recorded document from the clerk recorder. It doesn't necessarily need to be a recorded document. Back when the pandemic hit and the recorder's offices were closed, we accepted some documents that had dates of notary on there that we accepted as the transfer date. But once we then we figure out what percent transferred. If it was 100% transfer.
All right, everyone. Thanks so much for your patience. Looks like Keith's having some internet issues. He just completely dropped off. So there he is again. Thanks for
I
your
lost you
patience,
guys
everyone.
again.
Yeah, you dropped off for a second there.
Hello?
Can you hear us, Keith? All right, everyone. So sorry about that. Keith, are you able to hear us? Okay. Roxanne, I think you may have to step in at this point.
No problem.
Thanks for
Hi,
your flexibility.
Sure. Hi, my name is Roxanne Danielson, and I'm a senior title officer with Chicago Title. Next month is my 2-year anniversary here, and I've been in the business about 40 years. So today I'm going to talk to you about what's happening on the title side of reassessments and what we do on our end and how it affects the current owner, previous owner, and possible future owners. So I think I'm going to stop my video, correct?
No, you don't need to stop your video. You can just share your screen.
Okay, hold on one sec. Okay, can everybody see that?
Yes.
Okay. All right, so property assessments and their effect on title. We, as a title insurance company, we actually are responsible for making sure that the documents are accurate when we present them for recording. And so part of the information that comes on that is going to be, so we want to make sure that everybody understands how to read a tax roll. Important dates for property taxes. And when I was an escrow way back in 1979, I had an escrow officer that taught me no darn fooling around. And for me, that was a way to remember when the due dates for taxes were, because the fiscal year is different than the calendar year. So when we get to that information, I'll pass it along. Supplemental taxes and delinquent taxes, what triggers assessments, who's responsible for the tax bills, and the preliminary change of ownership report known as the PCOR or PCOR, and how it's going to affect your property taxes. So when we get our documents in, we actually go through and make sure that we have the new owner's name, or if it's a refinance and they're changing their tax information or their vesting, in and out of a trust or to an LLC, etc. We want to make sure that the return address on the document is accurate, that if there's a PCOR included with it, that it has contact information. The county just started rejecting PCORs that information wasn't on there. And that is either a phone number or an email. And the reason is, if there's something that they're unsure of, the assessor's office or tax collector's office can reach out to them and get further information. So the first step we're going to look at is understanding the tax roll. So the tax roll provides us with the property identification number, which we call the assessor's parcel number. And then we also include, I'm going to skip ahead to my next slide. Hold on. There we go. So this particular one, I've actually redacted the situs address and everything, but the assessor's parcel number tells us the book, the page, and our parcel number of our property. And so when we search a property, we want to make sure that we have proper ownership, we have the correct assessor's parcel number, we have the correct legal description. Sometimes we'll pick up whether there's an adjoining parcel and we'll question, hey, is this part of this transaction or not? So as Keith was saying, new construction will trigger a reassessment. And this particular tax bill, they received a county supplemental secured tax bill based on new construction. So that is a heads up to the owner of record that you just purchased this property, it's new construction, here's your bill. And it's from the period of time that they purchased the property until, the tax year. So the installments are set up in equal parts, but they're not paid every 6 months. They're due November 1st, delinquent December 10th. And then the second installment is February 1st, delinquent April 10th. If the taxes are not paid within that time frame, and the tax year runs July 1st to June 30th, then there are penalties added. And if those taxes aren't paid by the time the penalty comes, then they roll into what we call a redemption. So the redemption is the tax amount due, all the penalties, and then every single month it rolls up, and it's just like an ongoing assessment. And it's due and payable the minute the bill was issued, but we can pay it through a transaction. If you're in a a transaction with the sale of the property, you want to make sure, when did your seller purchase the property? Because those are key dates to look out and see if there is any kind of supplemental bill that's pending. The tax assessor's office is anywhere between 6 months to 24 months to reassess the properties and then issue the supplemental bills. Well, we know that a lot can happen within that time. So parties can sell the property. They may have someone that died. And so these are the things that can trigger a reassessment. So the recordation of an affidavit death of spouse, affidavit death of joint tenant, or a death of a trustee. When we have the PCOR with that, the PCOR is going to tell the assessor, along with that affidavit, if the successor trustee happens to be a son or daughter or a family member, because if it's just a single trustee that's just appointed by the trust, then that property is subject to reassessment. So they may record something and not do anything else with the property. So that's a possible trigger right there. Recording a quitclaim deed, grant deed, either to add someone into title or remove someone to title, that's also another trigger. And if you're doing a refinance, Ventura County Recorder's Office, if you're adding someone or removing someone from the title that's not a spouse, they're going to also collect document transfer tax based on the percentage that they own or are going to own, along with half of, or whatever the percentages of that deed of trust. So if you had a deed of trust for 500,000 and you had one party in title adding another, they're going to base transfer tax on 250,000. And that isn't necessarily a way that would trigger a reassessment. It's just a requirement from our county. And documents that normally would not cause a reassessment is if you're transferring from husband and wife or individual into yourself as trustee of your trust, adding a spouse into title or removing a spouse. And there are exemption recitals that we make sure are on the documents for the recorder's office, which tells the assessor this is what this transfer is all about. Whenever we have a corrective deed, it could be a name change, status vesting, possibly even a re-record because of a improper parcel number, legal description, etc. Those are not normally items that would trigger a reassessment. When you have a grant deed either coming in or out of a legal entity, that'd be a corporation, LLC, partnership. If the owners are the same, meaning they are the corporate officers, the operating agreement says that they are the managing members of the LLC or partners of the partnership, there's language that we put on the document that also lets the assessor office know these are the same parties, so they are not subject to a reassessment. And any documents that record that do not transfer title, such as a deed of trust, we could have a UCC termination or UCC, which is a financing statement, say for solar, windows, etc. Those do not trigger reassessment. And this is just a little sample of, so when we abstract our documents, we always look at, here's the information. We have to make sure that we have the correct parcel number. This actually was a deed where they were adding someone into title. So here is where we show our exemption, and it's saying that this is a bona fide gift. Grantors receive nothing in return. So we had a single man and a single woman, and they each held interest as joint tenants, which is 50-50. It's equal shares. So they ended up transferring 25% to the single man, 25% to the single woman, and then 50% to another single man. So what happens is this was an interim deed. So went from our single woman, single man as joint tenants to the three of them. And then subsequently, they ended up selling it to someone else, husband and wife as joint tenants. So in this particular case, there could be two separate reassessments, one based on the addition of the party into title, and then the other one based on the actual sale. So when we calculate transfer tax, it's $1.10 per thousand. That is a county requirement. Ventura County, thankfully, does not have city tax, so that's nothing that we have to worry about. Los Angeles now has city tax, and now they also have like a mansion tax. Properties that are in specific areas are also taxed at another different rate, which is totally different than regular transfer tax. So what happens is this transfer tax equates to the property value, what the property sold for. The preliminary change of ownership also confirms that same information. So anytime that we are doing what we just spoke about, whether we're adding someone into title, or perhaps let's say that all three of them were already in title, and instead of them being a single man, single woman, it's now going to them as husband and wife. Let's just pretend they got married. So this would be subject to a possible reassessment as to this person's 50% interest. So there's certain things that, as escrow holders, they're going to make sure that they prepare the document. Title, we make sure that they are prepared properly, accurately, if the transfer tax is correct, has a return address, anything else that might need to be included. So we make sure all of those things have been cleared before we record. And so when we're talking about who's responsible for paying property taxes, you might have a prior owner because of the delay with the reassessment. So if a supplemental bill or a corrected tax bill was mailed after the owners came out of title, the prior owners are responsible to pay it. And the bill, if the bill is issued after they've come out of title, it's no longer secured to the property. So should roll over to the unsecured tax roll, and that would be a lien against the parties, so the owners of title as of that time, and that becomes a lien against them and can attach to anything and everything that they own. And it could be one or two bills, depending on the time of the year that the property closed, what tax period they're in. So you could have something that might be in the 22-23 tax bill, or something that was 21-22 and 22-23. So it's all depending on the dates. Current owners, they are responsible for any taxes that are open. If they're delinquent, secured, and supplemental, so those all get paid through escrow. If your seller happens to have an impound account, most times they don't take care of supplemental taxes. So just make sure, if you're representing a buyer, hey, when your supplemental tax bill comes in, be sure to double check with your lender to make sure that that's included with their impound account. Because sometimes borrowers or buyers might say, oh, my lender's taking care of that, I'm paying for an impound account. And sometimes the lender doesn't receive that tax bill. They receive the secured taxes, but not always supplementals. And so a current owner should notify their agent if they've recently done any kind of construction, something that would require permits. That could be an addition on the house. It could be a construction of a swimming pool. It could be, anything that would require permits, because those are things that could require the property to be reassessed and a supplemental tax bill to be issued. So if you see that there is new construction, just kind of inquire and make sure when you get your preliminary title report, if you see supplemental taxes, that could be what it's for. If you don't see any, you can always check with title or escrow, and we'll verify if they had prior supplemental taxes that are paid, or they may not have been issued yet. So just something to be aware of. And then a new buyer will have prorated taxes on their purchase. So in escrow, we use the current tax bills as we have them. Escrow does a proration through their transaction based on the time of closing and the tax year. So that's something that escrow does. Title does not deal with prorations at all. And so a grant deed transferring title to a new buyer will trigger a reassessment of the property. So they can expect to receive a notice of value. It might be a little postcard. It could be a letter notice that's going to let you know what the value is now assessed at, but it's not an immediate receipt of a supplemental tax bill. So some people forget about it. Some people may have sold the property and never received their supplemental tax bills. So it's really important that if you know someone just recently purchased and now they're flipping it and they're selling the property, it's really important that they get their information to the tax assessor, because if they can't process the bill, it doesn't matter. It's still going to be due. It's going to have penalties, and then it could grow into a larger amount to be paid. So it's just really important to communicate that with your clients. The PCOR, that's what I call it, a preliminary change of ownership report. Some people call it a PCOR. So this was created through the assessor's office. The county tax collector relies on it as well. And the recorder's office, if we present a grant deed or an affidavit of death, and we do not have a PCOR with it, they're going to charge a $20 surcharge. And then they're going to mail one to the owner saying, hey, this wasn't completed. Could you please fill it out. And what that does is it actually helps the owner to tell the assessor, this is how much I paid for my property, or this was my spouse passed away. And so that tells them whether it's a event that would cause the property to get reassessed or not. So the PCOR, it basically has information that notifies the assessor, again, with the tax collector, as to what the value is as of the date of that transfer. So the taxes are all based on the current owner. When that change happens, then we have to be able to, make it known that there was a change of title. And so there are certain properties that are excluded from reassessment. Those could be the ones that we put that's between a husband and wife. So we want to make sure that when we record a document that it's clear what that transfer is all about, whether it is something that was for addition of a child. Back a few years ago, we had a parent and child exemption. We had 55 and older transfers where your property value could be exchanged for another property. So those have changed a little bit, and the assessor's website actually has all of the reports that are needed, as well as the Ventura County Recorder's Office. So if you have any questions in regards to yourself, a client, a family member, check out their website. They do have good information. As title, that's where I go to, and I try to get the latest information that I can. So if you have a need for that, I will send me an email and I will check into that for you. And so thank you for allowing me to give you a presentation. The taxes can be very confusing. We can look at something when we issue a preliminary title report, and we could be picking up information that was from a prior owner, but we don't know, because on our end, we only see the current assessed owner. We look at the parcel number, we double check, when the taxes were issued. And so if you have anything that has any kind of confusion, you can always check on the tax collector's website. They show history of payments. They also will provide you with the dates that they were paid. And if we need to do further investigation, I can always send them a request, and they can provide us with the actual payment, whether it was the impound account lender, the prior owner sent in a check. And oftentimes, not so much with Ventura County, but Los Angeles County, we have issues where we as title or escrow has paid the taxes, and for whatever reason, they get posted to the wrong assessor's parcel number. I have a file right now that I've been assisting with for almost 2 years, where Los Angeles, excuse me, took a check, they never applied it. So we put a stop payment, we issued another check. That second check, they applied to the totally incorrect parcel number. The lender paid the taxes, we paid the taxes, and now they're still showing open and delinquent because they have not been properly appointed to that specific parcel number that we intended to pay. So what happened is, now we found out that the tax collector refunded the money that was received in error to the owner of the wrong property. So here we are almost 2 years later, waiting for them to receive their money back in order for us to have our check posted so we can refund to the lender. So it gets very complicated, and I'm always available if you want to give me a call, you want to send me an email. It doesn't matter if it's not a Chicago title order. I'm happy to do the research, and I really love to solve problems. So that's what I really enjoy, and that's why I like doing title. So if you have any questions, please let me know.
Thank you so much, Roxanne. There's a few questions in the Q&A. I will try to, let's see. We have one from Dale. Are you able to see the Q&As, Roxanne?
Let me open it. Hold on a sec.
Because it's a long question. I want to make sure I cover everything. I'll read it out loud. What about a house that is furnished at the time of sale and there is no asset allocation? Say the furnished house sold for $5 million, which included $500,000 of personal tangible property. Is the new assessment recorded as, say, $1,500,000 for land improvements, $3 million in personal tangible property, $500,000? For real estate taxes, the realty assessed at $4,500,000 or $5 million?
That would probably be actually a question for Keith, because I don't know exactly what figures the assessor's office uses for those reassessments. I just closed a transaction that was very similar to this scenario, and there was personal property that was included. They did list everything and included it with the preliminary change of ownership report. So they showed the actual sales price, and then they also showed the value of those personal items. But I don't know if the tax assessor will go off the full sales price or the sales price less the personal property for the actual real estate value.
I can chime in on that if you can hear me.
Yes,
Yeah,
we can.
Roxanne, you're right. So they would post the sales price of the entire property. That PCR has a portion to list what that personal property it was. We would probably require some kind of list of what those items were so we can verify they are personal property, and that would be reduced from the sales price. So we would just then divide up the remaining $4.5 million between land and improvement.
Perfect. Thank you,
Thank
Keith.
you. All right, we have another question. I apologize. Where can we look for previous histories, etc.? Please, what was the website? Is that the county website that you listed?
Yes, that's under the Ventura County Tax Collector's Office.
Okay.
And if you just Google Ventura County Tax Collector, and when you come up to their site, they have a couple different items. So you can click on the pay my taxes, or I think it's something to do with making a payment. And then it'll show you what the different screens are. If it has ability to enter the assessor's parcel number or the physical address. So whatever is easiest for you, you can put it in any way. And then up to the upper right, there is a history. And so if you click on that, it's going to show you, usually it goes back about 2-3 years, and it will show you if there was a redemption that was paid, or just regular first and second installment secured taxes, supplemental taxes. And if you're not able to find what you're looking for, you can always contact someone here at Chicago Title, and either Dion on our customer service or Sav would be happy to look at that information for you, or myself.
Thank you. And I believe that website was listed on your slides, which I mentioned earlier, if you joined a little late, that the slides will be shared with everyone who attended. So there's a lot of good information in those slides that will be shared. And this is also being recorded. Let's see, we have a question in the chat. Will you please give an example of an existing owner adding a pool, no sale taking place? How is the reassessment calculated? Is it just the value of the pool only, or is the entire house reassessed at current market value? How can someone find out how much their taxes will go up if they add a pool?
That's another Keith question.
I can probably answer that too. So pools are pretty unique because sometimes the cost of the pool doesn't add as much value to the property. So what we would do is we would certainly consider the cost of the pool, but we would look at how that value, improvement added value to the overall property. In most cases, I can say we don't add 100% of the cost of the pool to the property, but we usually look at similar homes that have pools and what they would go for, and that would give us an idea of the value of that pool for that particular property. And in some areas, pools are a little more desired, and people want them in certain areas. In other areas, not so much in the county.
Perfect. Thank you, Keith.
Thank you. All right, we have a question from Michelle. What if the property assessment shows new construction completed and there wasn't new construction done at the property?
I would definitely say that, have a conversation with the tax assessor's office. Because they're going to look at whether the permit was pulled, if there was new construction, and perhaps maybe there was an error with the assessor's parcel number, but definitely start with the assessor's office. And Keith, is that what you would recommend?
Absolutely agree with you. Call our office to find out what happened. We might have received a permit on that and thought that that improvement was completed. And sometimes we don't know whether that happens. We try to get that information from the property owner. But if we don't receive that, sometimes we'll have to rely on that. We think that improvement was complete. But if you have an issue with that, you can call our office and it hasn't, that new construction hasn't been completed or it hasn't been started, you can let us know and we'll make that adjustment.
Perfect.
All right, we have a very detailed question from Fred. Will property taxes go up if, and there's a list. Number one, adding a garage, non-living space. 2, adding a barn for livestock. 3, change a large closet into a half bathroom. 4, a second kitchen sink to be installed on an island. 5, is there a difference tax rate increase for an ADU with and without a separate electric meter? 6, is there a property tax break for building a JDU for a disabled handicapped person? 7, adding a backyard patio, non-living space. And then he ends with, how is the additional property tax calculated when adding a room to the house?
That's
I think
definitely
I can
key.
answer those. So for adding a garage, yes, that would increase the value of the property and your taxes would go up. The same thing for adding a barn. That would be new construction added onto the old base year value. Changing the large closet in a bathroom would probably create an additional value in the property because you're going from one use of a closet to an additional bathroom, which is adds value to the home. Adding the second kitchen sink to install island will probably not increase any assessment. It would be quite low if it did, if there have some kind of a change to that island, but just adding a double sink or a second sink would not probably cause a reassessment. Is there a different tax rate increase for an ADU? No, that ADU would be considered new construction, and that addition of that ADU would be added to the old base year value of the main house, and so that would increase the property value and the taxes. Is there a tax break for building a JDU? No, there is not, although there is some exemptions if you modify your existing home to make adjustments for handicapped persons, and you can call our office to get more information on that. And then adding a backyard patio, if there was not one existing and you do add a new patio, that would be a reassessed new construction and add value to the property and increase the taxes. If it's a redo of that patio, it depends on what changes were made, if that would cause any reassessment of the property. So that one's kind of a find out exactly what change has been made and whether that they expanded it, made it more of an outdoor space than it was before. That could add value. And then the way that new construction works is you have your old base year value on your property, and any new addition that comes on is a new added value. So that new value gets added to the old value and it becomes a blended base year value. And then that's what is subject to the 2% CPI every year.
Great, thank you. So Keith, do we want to try sharing your slides or?
Let's try it. I think I'm in a better situation now.
Okay,
Stop sharing.
so, all right.
I guess I was here. I continue from where I was at before.
Perfect. That, yeah, we can see everything and you can take it away. Thank you.
All right. Okay, so I was just talking about change in ownership. And we have to determine if there's a change in ownership. We have to then determine what percentage transferred. And then we have to look at what that fair market value of that new property, which sets that base year value increase every year, the maximum 2%. So when it's 100% transfer, it's pretty simple. We take the market value at the time of transfer, or we review that to make sure that is the fair market value. That sets the base year value going forward, and that's what we track into the future. If it was a 50% transfer, we would value the property as of the transfer date at 100%, and then we would take 50% of the new assessed value and add it to 50% of the older base year value and blend those two values and continue factoring that at 2% every year. So types of transfers we have, obviously, some purchases. You can inherit property that can transfer it, especially if it's not between a parent and child, that could cause it to be reassessable. Roxanne mentioned interspousal transfers are not reassessable, but it could change ownership. And so we would have to make sure we add the spouse or remove the spouse from the title we have on for property tax purposes. Another big thing that I talked in front of your group before about was Prop 19, the intergenerational and the base year value transfers. Under the intergenerational transfer, the assessor does have to reassess the property, even though the child will continue to live in it and receive the old base. But if that child were to move out of the property, we would have to reinstate that base year value factor at the time the transfer went from the parent to the child. So we're still reassessing it, although it might not be shown on the value notice or property tax bill. And then with the base year value transfer, we also have to reassess that because if the new value of the replacement property is higher than the sale of the original property, that difference in value gets added to the old base year value again. So there's a blended value again that we would enroll in our assessment roll and then track that at the 2% a year. Roxanne mentioned the in and out of trust. We have to look at that. Refinancing is kind of a big thing, or was a big thing when the interest rates were low. So we had to make sure people, when they were doing that refinancing, is that they weren't adding people on or taking people off title because of that trust, because that percentage of that person's ownership that was removed could cause the reappraisable event. And one thing, make a note of for people that have property in a trust, that when they pass away goes to some beneficiaries. At the time of death, that is considered the date of transfer, and it would be reassessable if the property went to a beneficiary that's not maybe a child. But there's still the opportunity to file for Prop 19 intergenerational transfer reduction in that to the base year value. But that's something to keep in mind, that a date of death is actually a date of transfer that the assessor has to look at to determine if there's a reassessable event. And then, of course, our legal entities, corporation partnerships, LLCs, they transfer a lot, but when involved for reappraising the property, it's when there's over a 50% change in control. And that's what we really look at. But most of these types of properties have to file a form with the Board of Equalization and describe how that percentage change happen in their legal entity. And once the Board of Equalization reviews that, they'll send us a list of properties that show that we have to reassess. So some of that information we get from the Board of Equalization. Sometimes though, they might not file with the board, and we might determine that we maybe saw in the paper there was a change in ownership. We will reach out to the corporation to ask them to let us know what transpired in that transfer, and then we'll make the determination if it's a change in ownership. One thing I didn't list on this sheet, though, that's important to know is if somebody leases a property for 35 years or more to someone else, that is considered a change in ownership and would reassess at that date the lease is signed. So that's a unique thing that's in the Revenue and Taxation Code. And then most of the time for residential properties, we're just using a sales comparison approach to value the property. If it's a legal entity or a commercial property, most of the time we'll be using an income approach to value. The other way the assessor can reassess property is new construction. How do we find out about that? We received permits from the 10 cities and from the county for the unincorporated area. We have to review all the permits we receive. And then we have to determine if if that new construction is accessible or not. And then if we decide it is, we have to assess the portion that is new. I was talking about that before in one of the answers. We just take the new value. If it's new square footage, we'll look at that. If there's new fixtures or new bathroom layout, that would probably be considered new construction and add value to the property. And then we take the new base of that addition or whatever we consider as new construction and add it to the old base. And then that blended base is what goes up the 2% a year. So different types of new construction, obviously a new home, but someone had purchased some real property, the land, and hadn't built a home on it for several years. They have a base year value on the land that can only go up 2%. And when the home is completed, we assess the new home on that property and again blend those two values together to establish the assessed value going forward at 2%, maximum 2% a year. There's also an addition, a room addition would add some value to the property. The pool, we talked about that it might it adds some value, but not always the cost to construct it. And we even look at decks that would add value to the property. Most of the time, new construction is assessed using the cost approach because it's fairly new and we can get information from the owner of what they cost them. And also we have internal and external cost guides that would give us information on what approximately these types of new construction cost that we can add that value onto the property. So a change in ownership and new construction, create a supplemental notice. I think Roxanne did a great job of explaining how this occurs. So the notice really comes from the assessor's office telling the owner that purchased the property or complete the new construction what the old assessment was versus a new assessment. Shows that difference. That difference is what the amount of the taxes will be based on. So we again have to determine the date that the change of ownership occurred or the new construction was complete. Usually with new construction is when the inspector signs off on it as the final, or if the new house becomes livable and the people are living in it, then the date they occupied that property would be considered the date that the new construction was complete. The notice gives the owner opportunity to call us and talk to us about the value if they don't agree with it. We're very open to that because the assessor knows what the assessor knows, and if the property owner has different information that they think is important for us to look at to determine a value, we really want to see that. So they can call us. They have a 60-day period to really call us for this informal review, but in order to protect their rights, they would probably like to appeal the property. They have 60 days from that notice to appeal it, just to give them the opportunity to continue the discussion with the assessor's office before it goes in front of a formal panel to help decide who's correct as far as the value goes. The supplemental notice is an interesting document because we have something we call the window period. If someone purchases or completes new construction between January and the end of June 30th, it's called the window period. And there's two supplemental notices that would be derived because it affects two different tax years. The first year would be from the prior July 1st through the end of June in that window period. So whatever period's left from when that new construction was completed or the change in ownership occurred to the end of June of that current year is one supplemental that gets calculated and prorated for those months that they owned it or completed it. And then they also get the second supplemental notice from July 1st of the upcoming year through the June 30th of the next year. And that's really just the fiscal year of how property tax work. But if it's purchased between July and December, there's only one supplemental notice, and that is really based on the date that they bought the property through the end of the following June 30th, and that's a prorated tax bill based on the number of months they own it. But with all that said, there is one other way the assessor can review and change the assessment. And that's called the Proposition 8, Prop 8, or sometimes we refer to it as a Section 51 review. So after Prop 13 was passed, the legislators thought, well, what happens if the market value actually goes below that base year value factored forward? We don't want the property owners to pay that a higher amount if their property's not worth it. So they came up with Proposition 8. And this basically allows the assessor to review areas of the county if they feel there's a reduction in the market value as of lien date. You might recall back in 2007, 2008, when there was that great recession and market values went down quite significantly. The assessor had to review many thousands of properties in the county here and reduce those to the market value because it was lower than the people's assessed value. And that's a requirement by the law that the assessor puts the lower of those two values on the assessment roll. So it's very important that someone feels their market value is less than they're being assessed on their base year value factor to notify our office for a review of that. And then we will send out a notice in July telling them that we've adjusted their property value lower than their factored base year value. Like I said, it is up to the taxpayer sometimes to notify our office because we might not know something that caused the value of the home to go below market. We do reviews of neighborhoods and what we call clusters, so we make that determination. Just here in this past year, we did lower about 2,000 values because the people that bought in the mid 2022 saw some lower values as of lien date of January 1st, 2023. So we made some adjustments for those recent owners because their market value is less than basically what they purchased the property for. And obviously, again, they can always file an appeal if they don't agree with us, and they have from July 2nd to September 15th every year to file that appeal. So I have a quick graph here to kind of show you how Prop 8 works. If you bought the property in year one at 400,000 and you see that blue line going, that's the increase of the factored base year value 2% a year. In year two, you see that market value is 425,000, but the factored base year value is 408,000. We would assess the 408,000. Year three, the market value goes down to 375,000, and put the base year values at 416. Assessor will put 375 on that assessment, and basically that's when it goes on the Prop 8. We're required to look at that property annually to see what changes in the market. So in year four, the property went down some more, and we lowered that value. In year five, it's come back somewhat, but it's still not over the base year value factor. The interesting thing about this is that value went from 325 to 365. That's more than a 2% increase. It's 12%, but this is not under Prop 13 now. It's under Prop 8, and the requirements say that we would continue to add the market value onto the property until it surpasses the factored base year value. So 365 would have been the value we placed on it. Year six, it's still at 410 below. And then finally in year seven, the market value exceeds the base year value factor, and we would then switch that back to the 450 because it's the lower of the two values. Kind of concluding some things, just the way the review of the property tax system works. The assessor, myself, discovers and values all the property in the county. So that's really our responsibility. We not only assess residential and commercial, but we pretty much assess everything in the county: boats and planes, oil properties, timeshares. Everything's accessible unless it's basically owned by the government. Once we complete our assessments, we hand the assessment roll over to the auditor controller, and he applies the tax rates to the different areas in the county. He might process any corrections we make. They would prorate those supplemental tax bills to make sure they're prorated for the specific period of time that the property was owned in the county. Once they've completed that extension of the roll, they hand those extensions to the tax collector. The tax collector prints and sends out the tax bill and collects the taxes. So a lot of times on the tax bill, you will see the very first line says proposition tax 1%. That's the 1% Prop 13 tax I've been talking about. But there are other things that are on the tax bill that were probably voter approved, special assessments, or certain things for vector control, or some Mello-Roos gets added to the property taxes, wastewater collection fees get there. Those are all supplemental things that get added to the bill that are not in the preview of the assessor. But if there are any questions on how those taxes are calculated, there is a phone number that's next to each one of those on the bill that you can call and get the information you need on that property. And as we talked about before, the assessor's office is very open to phone calls, emails. Check our website. We want people to call and understand how their property tax assessments are made, understand the rules and the laws and the information that's available. We're very proud that we can get back to the people very quickly. If you email us, we have a 24-hour period that we want to respond. We have people answering our phones daily to direct your call to the expertise in our office to answer your question. We've redeveloped our assessor website. It has a lot more information in there. You're talking about history. Some of our history of properties goes back 20 years and what the assessed values were. So you can check that out. And you could always come by the South Victoria Avenue address and be in person. We'll have someone that can come up to the counter and field your question and see if we can get you an answer to that question right there in the spot. So please feel free to access our different avenues for questions. We welcome that, and we really want to make sure we can satisfy our customers that they understand what's going on. And with that, I can take any questions.
Thank you, Keith. And looks like we lost Roxanne for a minute, but she's back. But there is a question in the chat. How does a buyer over 55 years old transfer their tax basis from the house they moved from to the house they bought? Where do they start, and when do they do this, before or after closing on replacement property?
That's a great question on Prop 19. Prop 19 is a little confusing, but the first place to start is, again, our website. We have the forms on there that you would use to transfer that base year value and let us know that happened. The time to do is after closing on the replacement property, because it has to be, the replacement property has to be purchased within 2 years of the sale of the original property. So we want to make sure you get that information to us as soon as possible. There's also some informative information from the Board of Equalization. They have a little informational worksheet that talks about this Prop 19 base year value transfer and some of the ins and outs of how it works. But it is a great device for people to do throughout the state of California now. Before, it was just mostly locally, although Ventura County did accept properties from other counties. But this is a way people can transfer their base year value to any property in any part of California.
Thank you. We have a question. Are properties located in Lake Sherwood appraised differently than properties located in North Ranch or Westlake Village?
The answer to that is no. Everything we value is on the same principle and methodologies. So we would, they might be unique properties, and maybe we can't find a lot of comparable sales, but there are ways that we can come up with values for that. Reviewing the property, working with the property owner on that, and all the property, like I said, is same methodology, usually using the sales comparison approach with residential properties.
Thank you. Looks like we have another question in the chat. This is from Nicole again, who asked about the buyer over 55. Is there a tax reassessment for simple remodels of kitchen/bathrooms when not adding square footage?
No, there's not. Usually if it's just an update of the kitchen or the bathroom, it does not get reassessed. Where we see a reassessment is if you're expanding the kitchen, adding maybe an island to it where it reconfigures the kitchen, that's can cause a reassessment of the property. But it's a simple remodel of a kitchen bathroom. No, we'll probably receive a permit for that. We want to reach out to the property owner to find out if that's what's going on. But when we find out it's just a simple remodel update, it's not reassessable.
Hey, Diana has a question. Is there an extension on the Prop 19 transfer value of the 2 years due to COVID and homes not available as before?
There is not any extension on that. They basically use the same provisions that were under the Prop 60 and 90. So there wasn't any extension of that time for replacement properties. Although I can say there's some legislation that just moved through that for people that were victims of fire and lost their property in the Woolsey fire, they have extended the time for them to transfer that base year value. And I think that will be something the governor will be looking to sign. I haven't seen it come through yet, but looking to sign where they extended it to. It used to be 3 years. I think they extended it to 7 years because of the issue of finding replacement properties or reconstructing their properties that were damaged to the fire.
All right. Thank you. Any other questions, anyone in the Q&A? You're welcome to type any more questions. Looks like we are good. So as mentioned before, I will be sharing the slide decks for both presentations with everybody who attended and the recording as well. We'll probably get that out to everybody by next week. As most of you already know, we're getting ready for our MLS summer camp this Thursday and Friday. So it's all hands on deck for that great event. Hope you're all going to be able to attend. With that, thank you so much, Keith and Roxanne. We appreciate all your knowledge and expertise and appreciate you taking the time to share all that with us today.
You're very welcome. Thank you.
All right,
Thank you. It was
everybody
my
have a
pleasure.
great day.
Thank you.
Bye-bye.
Bye-bye.